everyone, this is Ali Safavi, the CEO and co-founder of COVU. I'm very honored today to have Marcus Ryu. He's a legend in the Insurtech scene. He's probably one of the OGs, original gangsters of Insurtech. He's the former CEO of Guidewire. He's I believe Marcus is still a chairman, but you could confirm. And he's now also a partner in Battery Ventures, a tier one Silicon Valley venture firm. So we're super excited to have him. He was kind enough to give us some of his time and to have a great chat. So Marcus, welcome to the podcast, and maybe you could tell us a little bit more about your background, and we'll just kick it off from there.
Thanks, Ali. I'm pleased to be here. Well, you've summarized my career pretty well because I've had a simple one. After a very brief transition from the academic world to the business world at McKinsey, I came to Silicon Valley, worked very briefly for a company called Ariba, which was hugely successful at the time. This was just prior to the crash of the dot-com boom in a different era of technology, and then left with some very talented co-founders, and we started Guidewire in 2001. Our first week in the office was 2 weeks after 9/11, which was a tragic and terrible time that really compounded the sense in Silicon Valley that that the good times were over and it would be a very different era unfolding from there. So we were braced at the start for it to be a much more arduous and frugal journey than I think the kind of boom time excitement that had prevailed in 99, 2000, 2001. And that expectation was certainly fulfilled. It was a very long and difficult climb, but of course, it was hugely gratifying along the way. It didn't always feel that way, and there were many setbacks. But when you pull back the camera, we actually did manage to achieve a lot, with far fewer resources than I think is the conventional wisdom is what you require today. So the company was founded in 2001. It took a long time to get initial funding, about 18 months or so. And it was kind of a nuclear winter. There were probably less than 10% of the venture capital firms, maybe even less than that, than exist today. And the terms were much less founder favorable than what's prevailed recently. We had to go a very long distance. We raised our Series A, I think, late in 2002, and it was another several years after that we got to our Series B, and then another several years after that, our C. I believe the company raised in total maybe $28 million in total, and we never even spent the Series C money. So, of course, you have to adjust for inflation, but our whole ethos was to be extremely frugal in a sense that money could run out at any moment, and that would be game over. And I think some of that sentiment, is beginning to return, to Silicon Valley, and I think that's mostly a constructive thing. I could share with you some of the challenges, but I know we're talking more about the future than the past. But I'll share that as a matter of public record, the company went public as the first IPO, first technology IPO in 2012 in January, and then I served as the company's CEO as a public company another 7 years after that. Through 2019, before stepping down, and I'm still chairman of the company. I still love it deeply. I believe I should be careful about sharing any numbers about the company that are not public already. But let's say over the last 12 months, the company has done more than $800 million in revenue, and it's fair to say that the getting to $1 billion and beyond is not that far a stretch. And that puts it in fairly elite company among software companies. But it's taken a long time to get there, of course. One big thing, many things happened along the way, but one of the biggest was a kind of change in the end market. Guidewire started out with a claim system, but very quickly expanded its strategic ambition to be a core system platform that does all of the big transactional systems of record that define a property and casualty insurance company. So policy administration, claims, billing, underwriting, et cetera. And then, it was delivered as an on-premise, highly configurable enterprise application. And that was really the kind of defined the strategic frame of the company for a very long time. And then sometime in the early 2010s, this new thing called cloud computing had emerged and became a kind of mainstream vector of CIO interest. And there was a sense that what our enterprise customers wanted was less a sophisticated, highly configurable enterprise application and more a kind of on-demand, highly standardized business service that was delivered in the cloud. And so that was a big, existential change for the company that was anything but easy. In fact, the company is still in the midst of it. And if you were to read our earnings reports for the last, 5-6 years, going into my tenure as CEO, you would see that that was a really preoccupation of the company is how can we transition, a very successful kind of conventional on-premise application company to a cloud company. And that's gone not without challenges, but it's gone exceedingly well. And, and the company is well on its way to really transforming its value proposition and becoming, in a way, fulfilling its longer term aspiration to become a kind of shared, highly standardized service for the entire, $2.5 trillion global property and casualty insurance industry. So I made the transition in 2019 after a very long and somewhat exhausting journey. Then COVID happened, of course, which disrupted plans a bit further. But then that I found it so valuable and so rewarding to interact with entrepreneurs like yourself, Ali, and that I wanted to do much more of that and to not be so utterly single-threaded on one thing, and and see a broader spectrum of what entrepreneurs were doing. I had the privilege of advising and consulting to a host of different software companies along the way, especially after the company went public. But I wanted to do it in a more kind of professionalized fashion, with a world-class platform. And so when the opportunity arose to join the battery investment team, I decided to make that transition. And I'm about 8 months into that journey now.
Very fascinating background, and that's quite the journey. So just for the heck of it, I'm curious, do you consider Guidewire an Insurtech? Because kind of the word Insurtech really feels like it was coined in 2016 or so. Yeah. I wanted to call it plug and play Insurtech. Our marketing team was like, don't make words up. That's not a word.
Yeah, that's funny that you say that. The term certainly did not exist when Guidewire was founded. In fact, in 2001, 2002, as we were talking to Silicon Valley VCs, it was a very contrarian and not popular decision to say we're going to focus on one industry. Part of the original theory that the co-founders had, we were not insurance experts. In fact, everything that we knew, the six of us knew about insurance, was a result of what I had learned from my office mate at McKinsey just during lunchtime, over my first, 2 years as a McKinsey consultant. So it was very shallow, very limited. But I had the intuition that that this was a category of software, or a category of problem that software could really be good at addressing. And I can elaborate more on that later. But the theory that we had as entrepreneurs was, look, the conventional wisdom is if you want to create an enterprise software company, you invent a new 3-letter acronym, and try to sell it to every Fortune 1,000 company out there. And that's how you created a CRM company, or HCM, or ERP, of course. And we said, well, actually, we're going to pursue a different vector. And the conviction was that the most mission critical, the most strategic applications are going to be specific to an industry. It's kind of intuitive if you think about it. And that this is a big dark matter, just an unexplored galaxy for the largest software companies, SAP, Oracle, Microsoft, et cetera, because they don't have the patience to understand the requirements of a given industry. And they're not going to be able to, they're going to try to continuously apply horizontal technology to industry-specific problems. So if you squint, you can say, what is a claim system? Well, that's just a form of case management. And what is a policy system? Well, that's just, a contract management system. And so they would try to be shoehorning very horizontal software categories into an industry. And the result is missing the requirement, making people very unhappy, and a lot of customer failures. So conversely, the other extreme then that many insurance companies concluded is, well, we'll have to build this ourselves. And the most successful insurance companies of the earlier era, they're still very successful, but the ones that were really, ultra successful relative to their peers, like a Geico or Progressive or USAA, said, we're going to build competitive advantage by building our own systems. And we're going to instantiate all of our specialized knowledge and expertise into our software system. And we're going to build it ourselves. And our theory was, look, that era is going to come to an end. It's just too difficult, too expensive, too risky to try to build your own core applications. And moreover, smaller insurers, it's just completely out of reach. And so that there is room for a standard package software alternative to that. And it's going to be specific to an industry. It'll be very difficult to get to. There'll be a very high barrier to entry and adoption. But if we get to the other side of it, we're going to be rewarded with a fairly open field. right? Where we're competing against internal development and consulting firms as opposed to seriously professionalized enterprise software companies. And we got a lot of things wrong along the journey, but that was basically correct. And I think now in 2023, and we understand that vertical enterprise applications, vertical SaaS, is a massive software category. And there have been a couple of examples much more successful than Guidewire, even like Aviva is the absolute shining example. Peter Gassner is a genius as an entrepreneur, and I recruited him briefly to be Guidewire's chairman during a number of years that I was CEO of Guidewire. And he has proven, and immodestly Guidewire has done its part, to show you can build very, very substantial venture investable vertical software companies. And now that's conventional wisdom, but it wasn't then. Now, with respect to Insurtech, that word did not exist. The idea that you would build an entire category of investments just serving one industry would seem laughable, I think, in the early 2000s. And now, if you look at the data, the last 8 years, $50 billion of venture capital has gone into Insurtech. Now that includes, life and annuities, health and P&C, but that is an astronomical sum that I would never have imagined, even inflation adjusted, would ever be invested just in serving or competing in this one industry. But there you have it.
No, very, very cool. So now let's jump and let's take it up a notch. I usually like to start a lot of the conversations with what is one of your most contrarian or controversial points of views, something that you feel like a lot of people might disagree with in regards to what happened or what are the opportunities today, or even in regards to the future of insurance.
Yeah, well, I'll just key off of the last thing I just said, was the amount of venture capital that's gone into Insurtech. Well, here's my view. I think most of that's wasted. I think most of it will not yield a return. And I think some of that's already happened, and I won't name names or certainly celebrate frustrating examples that have happened. But there was a lot of money, a lot of risk capital was invested in either serving or more controversially in competing in the industry that didn't really understand what it was getting into and really did not have a chance. That was strategically flawed, let's say. The most obvious strategic flaw was to think that you could approach the insurance industry or insurance market the same way that you could approach, let's say, a conventional SaaS software market. And the most egregious examples would say, well, $1 of premiums is like $1 of SaaS revenue, which it obviously is not, right? It has, obviously does not. It's a completely different kind of margin characteristics. But most importantly, you are entering into a financial obligation to indemnify your policyholder as an insurance company. And that means that a bad customer is not just bad or not just not as good as a good customer. It's a catastrophe. You're much better off with that one. And any insurance veteran will tell you it's very easy to grow an insurance company. Allstate could be double the size if it wanted to be. All it has to do is slash its premium, slash its pricing below everyone else, and it will win tons of market share. And it will also go bankrupt because you have to charge an actuarially sound price. And a lot of early entrants in, Insurtech entrants did not appreciate that. The second thing that wasn't appreciated was that this is a very venerable industry that has invested astronomical amounts over time to educate the public and to build consumer brands that are very, very difficult to dislodge. And that it's not a purchase that no one loves buying insurance, even people who work in the industry. Warren Buffett, famously called it a grudge purchase. People buy insurance because they have to. It's a statutory requirement. You're not allowed to drive a car or operate a business or hire employees unless you do it. So you're not going to make it glamorous. What you can do is make it efficient, and you can make it, lower cost. And but the margin for improvement there is pretty small, and the profit margins themselves are actually not that large. And as consumers and as citizens, we should be happy about that. The insurance industry is remarkably efficient. We get a very good deal from it. Of course, some of the profit, as the risk is pooled, goes to insurance industry participants. But when you contrast that to other financial services like asset management or even retail banking, it's a much less profitable industry. And that may not be wonderful if you're an insurance company, but it is actually a great social boon that we get this risk protection that protects people from the depredations of a risky world at relatively low cost. So what that means for venture, though, is it's not as though there's this fat pool of profit that, from lazy incumbents that can just be, plucked from the tree. That's not the case, right? You have to work very, very hard at it. You have to find new fundamental value in a chain that has been very thoroughly analyzed and understood by very smart people over a very long period of time. And consequently, the returns to Insurtech have been very disappointing. And though I see an impressive sea change in the way that the next generation of entrepreneurs are thinking about the opportunities.
So I'm curious, like looking back at examples that you are mentioning without mentioning, in a sense, like the public market, especially examples. Do you feel like those businesses so it sounds like you're saying fundamentally there's no way for them to work, as opposed to it's just a valuation problem? Because I think initially a lot of people were saying that, look, these companies were just mispriced because premium was considered SaaS revenue, which is ridiculous. But what you're saying, or at least what I'm hearing, is because a lot of the market is already with bigger companies, and unless you misprice everything, and obviously you're going to have underwriting problems, you're really not going to be able to like just move them. So it means like these businesses are fundamentally flawed, and there's just no way for them to make money.
Yeah, I don't want to dwell on the negatives, but I will say that in some cases there were upside down businesses that if the premise was we're just going to create a better consumer grade customer experience, and then we're going to take all this market share and we'll just be more efficient, and because we're smart Silicon Valley guys, we're going to make that work and grow at hyperspeed. That's obviously very flawed strategy. That's kind of fundamentally flawed. I don't know if anyone would have expressed it that naively, that crudely, but I have had some conversations that suggest that some people were thinking of it that way. I think that's flawed, but there is opportunity for fundamental value creation in insurance, and where I talk to entrepreneurs today that excite me are in the following areas. The most exciting area is, can we take all of these new emergent data signals and draw them into the insurance process, and then use them to make better underwriting decisions, better pricing decisions, better claims decisions, and then directly address the heart of what insurance is about, which is reducing indemnity, right? The actual loss itself, right? So making better decisions and then actually preventing them in the first place, right? And so I can speak about the investment that I sponsored, the one investment that I've sponsored so far at Battery, Fairmatic. They bring smartphone-based telematics to commercial auto insurance. And I won't promote that company. I think it has fantastic prospects, or I wouldn't have sponsored our investment in them. But let's just talk about telematics in general. This is very well established. It seems like old news.
Marcus, feel free to promote Fairmatic. I mean, we're not sponsored, so if you want,
yeah,
because like a lot of times it's easier to just dive into a company and give it as an example. So I mean, I personally have nothing against like promoting another company here if you feel like that's.
Oh, sure. Yeah, I think it's a great company with a great leader that has and a great team that has really interesting prospects. But but I think the sort of signal, so to speak, to take from that is that it's part of a larger theme, and that theme of harnessing alternate data signal than the ones that the industry has conventionally used, and using it to make better insurance decisions. So telematics is extraordinary. I mean, it's kind of old news, and yet it shouldn't be, right? The data science and the behavioral science of telematics is incredibly well established. It's rock solid. If you talk to actuarial firms, they will tell you. Here's a great example that. The insurance industry spent untold amounts of money and effort, including lobbying and technology investment, to get credit score as an underwriting criteria, because a person's credit score is somewhat indicative of how good a driver they'll be, what kind of risk they are. Well, it turns out that the score you get from telematics, which is not doing this sort of oblique correlation between how you are as a credit risk to how good you are as a driver. It's assessing directly how good a driver are you, right? How much are you accelerating too frequently and doing hard stops and sharp turns, and how often are you looking at your cell phone when you should be looking at the road? It can look at that directly. So needless to say, the quality of signal that you get from telematics is an order of magnitude, maybe 2 orders of magnitude better than you're getting from this underwriting criterion that the industry spent all this effort to try to bring into the process, right? So, and yet, why isn't it ubiquitous? Well, it's going to get there, I believe so. But there's end market issues, there's distributional challenges, and these are the things that today's Insurtech entrepreneurs have to overcome. But that's exciting stuff, right? Can we mainstream and provide broader adoption in something like that signal? Another area, for example, is computer vision. it's quite a bit earlier, but the state of the art in computer vision is remarkable right now. You can take a 3D image, a 2D image, and you can assess, well, hey, there's a forklift that's driving, too quickly too proximate to other moving machinery, and that represents a hazard, right? You have a worker that's not wearing PPE, a helmet or a vest, and they're bending over too sharply as they pick up an object that's too big for them, right? These kinds of things are now discernible in computer vision, and it's remarkable, right? That stuff was science fiction, 20 years ago, and now you have terabytes, petabytes of data that are completely unexploited right now, that companies have, that have all of this incredibly insurance-rich information that can make better decisions. Now you contrast that from the gold standard in insurance today, which is, well, what's your loss experience? How many losses did you have last year? And how many employees do you have? And yes, that is obviously somewhat predictive, but it looks positively primitive compared to the signal that you can get by looking directly at the hazards that lead to loss, right? And the technology today allows us to do that. Now, that does not mean that it's instantly obvious that you're going to build a fantastic business there. It's, you have all the normal challenges of end market adoption and getting brokers to understand it and consumers and businesses to adopt and all of these kinds of challenges. But the opportunity for fundamental value creation is enormous, right? And I could again contrast that from the sort of V1 of Insurtech, which was, hey, these insurance companies, they're old and they're dinosaurs, and we're going to create an Amazon-like experience and we're going to just eat their lunch, right? That was, I think, naive on its face. Whereas this next generation of Insurtechs are, all tackling hard problems, but are addressing a much larger, pot of gold.
Very interesting. One thing that I wonder, like you spoke about Informatics, there's a very big public company, and again, we could talk about names, but put it out in case for the marketing team at Battery might not be okay with that. That company also had a lot of claims like that, right? Like fundamental underwriting is flawed for auto insurance specifically, and we're going to use driving data and it's going to be much better. But then it did not happen that way. They kind of pivot back to like credit scores and actuarial models and all that. What do you think happened there then? Because I think the premise makes sense, but I feel like a lot of the attempts to it have had fundamental issues. I mean, and on the other side of it, of course, is regulation. Like I know for a fact a lot of states are not okay with some of these kind of stuff, and they're really like, they might allow you to like not underwrite someone, but if you're using them, you can't really use it for pricing. So
they have to be very careful about redlining laws and biases and so forth, and those are always constraints. But the insurance market is evolving, and nothing happens overnight. First, for one, there's the excess and surplus market, which is where a lot of innovation happens. Informatic at its start, kind of to get a quicker start, focused in that segment with ENS products, and is now building it, and now is also playing in the admitted market, which is a kind of state by state journey, but they're doing it. So those frictions exist, and I think they're there for good reasons. As I mentioned earlier, the distributional challenge, the communication challenges are hard, and trying to find what a consumer will embrace is not obvious. It's just not always obvious, and it takes lots of trial and error for people to get it. And should it be delivered as a carrot or as a stick, and should it be should it be bundled, or how often should the pricing change? All of these things require lots of experimentation, and that's the kind of thing that that the startups are really good at doing. And of course, some fail along the way. The thing, auto is obviously the largest line of insurance, and probably will be for a long time. It's also, the margins are very skinny in auto insurance, and the results in the last year or two, as everyone knows, have been really poor. I think that's because of a deterioration in driving, and distracted driving is really on the rise in a frightening way. But the margins are intrinsically very skinny, and it's been picked over by some of the smartest people, who working for great companies like Progressive and Geico and State Farm and Farmers, and they have enormous multi-billion-dollar books of business that have been thinking about this question, and looking at it from every angle for a very long time. So the other category of opportunities that really intrigue me are in less addressed industry segments. and in the possibility of the industry indemnifying new categories of risk, like cyber is the kind of classic example, which I think is disappointed in terms of its rate of growth in the early years. But, things that people get disappointed with initially tend to, often in the technology world, kind of return later, and sometimes just in a second form where they become, adapted, and then, to better meet what the end market really wants. And so I think there's no question, given the underlying risk that cyber represents, that there will be, that there will be a generation of there will be a very meaningful P&C line over time. And then other kinds of risk that are not well indemnified by the industry today, like supply chain risk and reputational risk, and there's a whole other universe of new emerging risks that the industry needs to get to. But what they need is the right kind of data signal, and in order to build the kind of rigorous underwriting and distribution, the rigorous underwriting and pricing models they need, that they can then attach to their existing distribution systems.
So it comes back to underwriting as well. So generally, it sounds like where you're most excited about is alternative data signals and.
Yeah, well, that's one big category. Actually, I didn't. There's another huge. Let's say that's Roman numeral 1, and the big Roman numeral 2 for me are what are the enabling technologies that help existing insurance players that work in distribution or in actual risk. How can we help those participants do their job better? Obviously, that's what Guidewire was all about. We did not try to pick winners in the insurance industry. We loved every insurance carrier, whether they were doing well or not. We were there to enable them and try to liberate their knowledge workers from some of the tedium and bad ergonomics of their work environment. Create a consolidation point where they could simplify an overly intricate IT environment, and get on with the business of creating their brand and doing insurance. So that's what Guidewire has always been about and always will be about. But there are many more specialized players that are looking at one particular slice of the process. As you know, the insurance value chain is incredibly intricate. There are many, many different stages, many different disparate processes, and each of them affords an opportunity for process improvement and for better technology. Some of those maybe get a turbo boost from the Gen AI advances that have kind of enthralled us all. Some of them just applying very well established approaches to better digital experience that are well understood from other industries can be applied to insurance. And then I think it's less glamorous than Gen AI, but the techniques of machine learning, which have been well established and developed over time, I think are now being applied to certain areas of insurance risk with greater rigor. So, for example, one of the largest categories of insurance risk is bodily injury, whether it comes in the form of workers' compensation or first or third party liability. It's an injured human body. And that's a massive, massive driver, of course, of insurance loss. But there's such an enormous corpus of data, even within individual companies, to understand how do these claims progress? Why do some claims get resolved relatively quickly, and why do others, take years, and some end up in litigation? And we should be able to interrogate this huge corpus of data and figure out which interventions at which point in time make the biggest difference. And then using better digital technology, we should be able to represent those courses of action to the people working at the front line, the claims examiner or the nurse case manager or whoever it is, and help better decisions get made that actively reduce indemnity. And if that happens, everybody wins, right? Everybody wins. The insurance company wins, but the consumer and enterprises, the whole economy wins, because the cost of indemnifying risk drops, right? And that's a social good for everyone. So again, fundamental value creation, that's not so much interpreting a new signal, that's just applying kind of well-established horizontal technologies to existing insurance problems in a very complex value chain.
Got it. That makes sense. So now let's change gear a little bit towards the future. We spoke about it a little bit, but I want to go deeper. But because basically what I want to do is that I want to paint a picture of the future. Let's say 10 years down the line. And because we want to look at everything, let's go very quick on each topic. I just want to, how are you feeling? And of course, no one has a magic ball. It's all about feelings, right? Like it's just at this second, and Marcus might change his opinion in a month, but today, this is how he feels. So let's start with the future of insurance. And we could start with, because something that we were just talking about right now, we'll go a little bit deeper, it's cyber. So it sounds like cyber, like let's just talk about the category of new risks. So in the future, how much do you feel like 10 years from now, is a timeline? how much do you feel like there's going to be a shift in just the market size? Like if we're talking about the P&C market, or we're talking about the entire insurance market as a whole, like how much of the market is going to look like today, or how much of it's going to be like new risk like cyber, supply chain risk, or some of these
Well, I mean, existing risks are well understood. There's all kinds of new signal. We can understand them better, but they're going to remain the massive, the massive preponderance of this multi-trillion-dollar industry are going to be well understood risks. Damage to buildings, damage to vehicles, damage to human bodies. That's what matters, and we know the perils that lead to those things happening. We can just understand those perils more in greater detail and with greater predictive precision. So that will be the case for a very, very long time. But I think that I foresee a future where the barriers to draw many different alternate data signals, find actuarially sound, or I'd say predictively sound, an underwritable new signal for risks that have been historically uninsurable. That's a future that I optimistically hope will happen, and that will be a contributor to the growth of the industry. The other contributor I hope to see is a closing of this massive underinsurance gap that we have. Every important category of insurance, except maybe auto, there's a huge underinsurance gap, and that's a distributional problem primarily. But as that's another major lever for the industry to be a lot larger, which I think would be a social good for everyone.
And then when you're thinking about distribution in terms of how people look at this, what is the future that you see in distribution? Do the agents have a role? Do the brokers have a role? Is embedded a big thing? Is it be all about like direct distribution? What do you see?
So the death of the insurance agent has been foretold many times incorrectly. I think it's an interesting question. Why are insurance agents still so important to the buying process, even in personal lines insurance? Like a good portion of them. I mean, even though inexorably direct distribution is like chipping away at it, but it's so much slower than anyone could have imagined. Why is that the case? Whereas the travel agent as a category was completely euthanized, like in the space of what felt like 2 years. Why has that happened? And it's because of the nature of the product. It's so much more involved, and requires this kind of advisory relationship and the like. And even with these generational changes, millennials, Gen Z, et cetera, that progress towards fully digital distribution has been so much slower than people thought about. And so I personally believe that that agents play a very important part in the distribution, obviously in distribution, but in the whole value chain, in education, in prevention, in loss management, et cetera. And I think that there's lots of room for superior enabling technology. And I know that's some of what you're working on, Ali. I commend you for that, because it's I think they have an important role to play. That said, we're becoming everything becomes more digital. It's just but slower than anticipated. So even e-commerce's share of 25 years after the advent of the commercial internet, still the vast majority of commerce still does not happen through a digital channel. It may not feel that way sometimes when you have a river of Amazon boxes coming into your house, but that is the case. And so there will still be a room for, I think, all the conventional ways of that insurance is discussed and distributed today, but hopefully with dramatically more efficient operations that fulfill that promise.
So how much of the market do you feel like is going to be captive distribution, independent distribution, and then direct distribution?
I couldn't really predict. I do want to comment.
Maybe even embedded, because like embedded is one of those things that.
Yeah, I was going to comment on embedded. It's an interesting question. It's been kind of an exciting category, but I'm very much a wait and see posture with respect to that, because there are some examples, and you could call it embedded insurance. Assurian was arguably the most profitable insurance company ever, just from figuring out that inserting themselves at the point of purchase for a cell phone, for a smartphone, consumers were really receptive to the value proposition, to buy that protection, and that was a great insight which they executed on incredibly well. However, that has not worked as well in many other segments for whatever reason, and the insurance purchase in general tends to be different for whatever reason. I'd only be speculating in the way that consumers, let alone businesses, think about it. That it's hard to move that purchase decision, I think, to the channels different than where it happens today, and especially as those other conventional channels become more and more consumer grade, more and more easy to use, and more intuitive. So I don't think, at least from what I can see today, that embedded insurance as a phenomenon is going to become more than a kind of niche phenomenon for quite some time.
Got it. Yeah, and I think at least for me, the vision of the future is like captive. I don't think it makes a ton of sense. I understand it, I appreciate it, but I feel like the role of the agent or the advisor, like there needs to be a role of an advisor kind of thing, because insurance is complex. And we spoke about under insurance, which I feel like that's where we need to kind of fill all of the gaps, and especially as we move more into advisory. And that's why captive doesn't make sense, because it's very biased. It's talking about like one carrier, right?
Yes. Yeah. I mean,
advisor is a sales.
the major, farmers and State Farm would, and other captive based platforms would have their own opinion, which is that we can serve this advisory role, not between different insurance companies, but over all the many different kinds of risks that a small business or a consumer should be thinking about holistically. And I think there's room for that. I think there's market appetite for that. But broadly speaking, I would agree with you, Ali, that I think that what people want for all their purchase decisions, by the way, not just insurance, just consumer decisions, like I want to buy a new printer or whatever. Like they don't want to go to the HP website and just be advised by HP alone. They would like some advisor that sits kind of in front of that says, let's understand your requirements and think across the universe of different choices, right? Right now, that's kind of a miserable experience in e-commerce right now. And I think that's one of the things this is kind of a lateral to insurance observation, but I think that's going to get dramatically better, where there'll be more advisory function, perhaps Gen AI enabled, that will help you make kind of complex purchase decisions, sitting above, the universe of choices. And that's very much what it would be like for the next generation insurance advisor.
Makes sense. And speaking about carriers, do you feel like in the future, if we're talking about like the P&C distribution, P&C market as a whole, how much of the P&C market in the next 10 years is going to be dominated by the older players versus newer players or new entrants in the market? And is that going to be more for dominant products that exist today, or is it going to be for the new product categories like cyber and so on?
This is hard to say. I mean, the insurance industry, again, doesn't obey quite the same rules of industry consolidation, industry concentration that you would get from like an academic study of the topic. And I think it's interesting to think about why. Some of it is definitely regulatory obstacles that make it non-trivial for national carriers just to permeate the entire market space, and has left room for for regional and local players that would seem subscale from the outside and yet have had remarkable durability over very long time horizons. So I think so then that combined with, so I think that phenomenon persists. I don't know why that would change, even though maybe there will be I think the data shows like a sort of gradual take of market share by the very large national players, but it's much slower phenomenon, and I don't know if that's monotonic. But I'm not an authority on that by any means. I just look at the same data everyone else does. More speculatively, I think there is, this incredible boiling cauldron of new emerging insurance startups that, the classic motion, as Ali, is to start with, a tech-enabled MGA. But just the nature of the economics are such that there's a powerful motivation that once you've found some product market fit and, get a book to a certain size, is to try to capture the totality of the value and become a full-blown carrier, right? So I think it's a very productive dynamic in insurance that you can create new ideas, can get out there fairly quickly, despite the industry's reputation. And there's so many more like insurance startups and both conventional and like really tech forward than one would think naively. And I think that's great. So I think it will remain a very dynamic, very complex and heterogeneous world for a long time. Unlike other places like technology, by the way, which is getting uncomfortably concentrated in just a number of mega caps that seem to own the totality of the value chain, which is uncomfortable for me, and for those of us that work in the tech investing world, because it's just too much concentration, in just a few names. But that doesn't seem to be happening in insurance, and I don't think it will.
And lastly, when we're thinking about the future, when I was at Plug and Play and I wanted to leave, for me, I tried to reimagine what the future is. And a lot of it came down to the idea of risk management versus selling insurance, because I felt like, look, insurance started in the 1600s. There's even the statistics weren't there, right? So then statistics later, and it became better at more modeling, actuarial science, all that, but it hasn't really changed as much. And if we were to truly reimagine it using data and tools and everything else, we need to move towards holistic risk management, something that's built around the customer, not a risk. That makes sense. It means like, I want to understand what Marcus's risk is and manage that on behalf of Marcus, as opposed to just selling him auto insurance because he has auto, and then the risk around having auto. Not sure how much does that make sense to you? Do you feel like?
No, I certainly agree with that. Theoretically, I think the question is then, now that you have you understand your risk profile, and then you say, well, how do I syndicate some of this risk? How do I indemnify myself against some of the exposures that I face? Because some of them will be catastrophic. And so you have to go to a market. You need a market on the other side. You need a counterparty that you can pass this risk off to, and where that risk is efficiently priced, so that you don't have to pay some extortionate amount in order to protect yourself. And then you need to have assurances that that counterparty is going to be there when you need to collect. When that risk comes, that small probability of a calamitous event actually happens. Well, is my counterparty going to be good and follow through on her obligations, right? And so that's what has led to, I think, both kind of the regulatory framework, which is not perfect, of course, but is, I think, actually pretty decent, and ensuring that, to overuse the word, that there can be a robust market where that risk can be sold, can be priced and sold. And then that you have very strong assurances, will be fulfilled. And you can see how bad it is when that market breaks down, and we see examples of that in insurance, like, classically and very painfully, like in the Florida property insurance market, right? Where you have a failure to efficiently and accurately price that market, you have too much political intervention, and then you have a market failure. And then insurance cannot do what it's really supposed to do, which is send a social signal back to say, don't build, don't build property in these zones because the actuarial risk is far too high, and to say, well, no, to hell with that. We want to build there, and we're going to mandate the price. Well, then what happens? Then the losses occur inevitably. Then they get socialized, and that's terrible for us as taxpayers and citizens. So I think what we want is a more robust and mature insurance market that operates with clear guardrails and functions smoothly. And I think it's a mark of a civilized society that you have a mature and substantial insurance industry. And it's one of the things in a complicated world where there are lots of things going wrong. It's one of the things that I think is working pretty well.
Makes sense. And just because we're running out of time, last question, but I would love to kind of get your thoughts on what are some of the key trends or technologies or opportunities that are happening in other industries that's going to have a major impact on insurance. Like, for example, generative AI is a very hot topic these days, and a lot of people, even we have put out articles on it. I'm speaking about like the impact that it could have. But anything that really excites you, or feel like the insurance industry or Insurtech needs to be aware of?
I think clearly the largest category is artificial intelligence, and what will it really mean? Not just in the Gen AI form, where like you can generate content, but okay, when can you find? And I think we've all been amazed that the kind of the power of current computing, current current modeling can find extraordinary statistical regularities that then are amazingly useful for making predictions. Including the predictions of what words will amaze you at the other end of a prompt, right? And to be able, but that's what insurance is doing. More than any other industry, it's in the business of making sophisticated predictions. And I think harnessing more of that with ever richer data sets in ever more consumable form, I think, again, will lead to a social good where the risks that we all unavoidably face can be understood, can be priced, and can be avoided.
Well, Marcus, I know we're at time, so I really appreciate you being on the podcast.
Sure.
Really enjoyed the conversation. A lot of great insights, both from your Guidewire experience, as well as obviously being at Battery and seeing a lot more in the space now. So thank you so much. And any last words?
No, thanks. Thank you, Ali, for all that you're doing to facilitate the community. And it's a privilege to participate.
Thank you so much.